I want to welcome everyone. For those repeat investors who have been on our REEP huddles before, you may notice we're actually in a different room than we typically are in. Our podcast room is currently under construction. And here at REEP, we are continuing to grow so much that actually our entire, I want to say half of our office is under construction. So today we're joining you not from our normal podcast room, where you would normally see us for these REEP huddles, but instead from our conference room. And before I introduce you to today's guest, I also want to welcome everyone new. We will be recording today's session because, Matt, can you believe this topic and this huddle on K1s? We have hundreds of people registered.
I know. They told me that, and I said, that's great. You know, this is my first one, so I hope I do good. So, yeah, thanks to everybody for coming.
Absolutely. We certainly appreciate everyone's time joining us for our monthly REEP huddle. And Matt, before we dive into these K1s, how about you introduce yourself?
Well, my name is Matt Swanson. I'm the Director of Accounting and Finance here at REEP. I've been here just a little over a year. You know, I have about 6 years in multifamily accounting experience.
He does, and he does a wonderful job of making sure all of our properties just have extremely clean and very, very crisp financials month in and month out. And does so much every year for our K1s, getting prepared for tax season. It isn't just a Q1 report or a Q1 item we have to get done, but it happens throughout the year. And that is something we are just so happy to have here at REEP and have those trusted partners like our CPA to really be able to put us in a wonderful spot and really have success there.
Yeah, REEP, you know, the financial starts on the operating team, and they make it easy for me. You know, when the ledgers are clean, it makes my job easier. But yeah, basically I'm in charge of making sure that the accounting department's running efficiently, that we have plenty of cash in the coffers, and also that our books are clean. And so to do that, I just make sure that, you know, the banks are being reconciled correctly, make sure that, you know, operations is doing what they need to do as well. And we all do a great job.
Absolutely. And Matt, before we dive in further into your team and more on what it takes to get a K1 done and everything that goes into how we make your tax season efficient, smooth, and timely for your multifamily investments. I know, and it looks like we have a lot of new people here on today's call. And so I want to welcome you again, but also just share a little more about REEP Equity with you. As Matt mentioned, we're multifamily, we're a vertically integrated investment firm. And we're actually calling today from our REEP headquarters here in San Antonio, Texas. But currently, REEP owns and operates about $720 million of assets under management. And that's throughout here in San Antonio, but also in our portfolio in Houston and Austin as well. And with that $720 million of properties that we have in our portfolio, we've raised about $225 million from our investors, our partners, as well as our own money into these deals to generate that passive income and really be able to reap all of those multifamily investment benefits that we all know and love and also appreciate so much. One of them being the tax advantages, which we'll cover more of today. And also, before we dive in, if you're not a part of the REEP Investor Network, we certainly invite you to do so. I believe our marketing team is actually going to put up a few links that we may call out or discuss in today's call. And so please be on the lookout for that chat box, but also be able, we want you to ask any questions you have either in that chat box or the Q&A box of Zoom. And with that, I think we'll go ahead and get started.
Okay, sounds good. Can't wait.
Also want to remind everyone that here at REEP, we are a multifamily investment firm. We partner with some of the smartest people, not only in this industry, but also in taxes. We rely on our CPAs a lot, but I will note neither Matt nor I are CPAs. So please do not construe this or take this presentation today as either tax or financial advice. Of course, as any good investment, a thesis is, please rely on your tax consultant, CPA, or financial advisor for those strategies.
Definitely.
Now, K1s. So in 2023, we actually issued 2019 K1s to our partners. That was across all entities. It's the most we've ever done before. And it was a lot of work. We're very thankful not a single K1 was printed from our ends. All of our K1s, of course, are done electronically through our REEP investor portal, which really makes it very quick and easy for our investors to access them, send them out to their CPA, and really save them for their annual tax purposes too. But Matt, really, before we dive into the meat of these K1s, what does it take to produce them each year?
Yeah, so, like I said, it starts with the ground team, starts with, putting good stuff in the ledgers and having that all be correct. As far as my end, I just make sure that the balance sheets and our trial balances and our journal entries are all making sense and correct and accurately stating what's going on. I mean, there's some events that can create, some issues, if a fire happens at a building, that could be a complicated entry, blah, blah, blah. But it's really staying on task and making sure our processes and procedures on not only the accounting department's end, but the operational end are airtight, or as airtight as they can be. And when that happens, then, the rest, it makes my life a lot easier, right? Fewer things to go in and clean up, and so that's really what I've been focused on for this past year, not only, getting a lot of new people in the accounting department, but also making sure our processes and procedures are good and correct and, make the best, most accurate financials that we can. And, I'm really proud to say that REEP does a great job at that. And we really work cohesively as a team. So, you guys might be asking, hey, how did we get our K1s so early? And that's really a testament to REEP working together as a team as a whole, makes my job easy.
Oh man, you covered a lot in that, Matt. But kind of backtracking a little bit. So this is making sure all of our invoices are turned in correctly by our the on-site staff, our managers, assistant managers, things like that. But can you also go into more detail, kind of the maybe not so much detail on the reclasses and accruals, because we don't want some people to go to sleep like I would. But really explain kind of on a monthly or weekly process, kind of what y'all are doing on those reconciliations and accruals.
Yeah, so what's a reconciliation anyways? We take a look at bank transactions, we make sure that they all line up. What is my team doing? They're also going in there and saying, okay, is this hitting the correct balance sheet account? Is this hitting the correct expense account that it should? She talked about coding invoices. I introduced a third-party software that comes in, make sure that all our invoices are getting submitted directly to our accounting system. So that makes our life easier and easier for the property. So that also helped a big, a ton there. But, there's a lot that goes into it. I don't want to put you to sleep either. It's not my goal, but it's mainly, staying on top of the bank transactions, making sure that they're coded in the right spot. And that's a huge part of it, frankly. That's a huge part of it.
And last week you said, when we were reviewing for this REEP Huddle, you actually said that doing that on a consistent basis throughout the year allows us and allows the end of the year to really just have and put a fine-tooth comb through everything. Is that correct?
Yeah, you got it. I mean, think of it, it's like you got your house and you got guests coming. If you're constantly maintaining the house and cleaning it up, when their guests come, it won't be that big of a deal to make it ready for them. But, if you don't do that and then you got guests coming the next day, it's going to be a lot harder. So I don't know. I hope that makes sense. That's
It
kind of,
does.
if you're staying on top of everything and making sure things are being done on a weekly basis, daily basis when it needs to be, it makes life easy.
That is awesome. And then once the financials are done, of course,
Yeah.
and this is every asset, every single property entity within REIT's umbrella, you pass everything actually to our CPA,
Yep.
which is Weaver. They're a nationally recognized firm, and just extremely knowledgeable in the multifamily space, but also the tax space. So when we file these returns each year, we can really confidently say that, as you said, not only are our financials airtight, but our tax returns are as well. And that, as an investor myself, that puts me at peace and me at ease, knowing that not only are they done on time, but they're done correctly. And so tell me a little more about what is sent over to Weaver in that package on top of the financials.
Sure. So they want to see, your trial balance reports. They want to see your GL reports, which is every single journal entry, basically, in every general ledger account. They want to see your balance sheet and they want to see your income statement. Those are the big ones. Typically, what I do is after that, I make sure our trial balances tie to last year's, and a lot of nitty-gritty stuff to make sure that what I'm giving them, they can plug into their software and run it correct. Weaver not only does our K1s, but they also help with depreciation expenses, and amortization, so loan fee amortization. So if you're looking at an income statement, you say, whoa, December we have this big depreciation expense. That's that's Weaver doing that. And we also have to amortize our loan fees. So, that's part of the gig. Also, we got to make sure that I give them their cost segregation, breakdowns. I don't know if we're going to get into that later, but that's also a big part of it, and Victoria and her team really help out making sure that that gets done. And so, once we do that, then we get on a call, they say, hey, Matt, I think we need to do these adjusting journal entries to book, depreciation and amortization expenses. And what do you think about this? And what's this? And then I answer a ton of questions. They say, oh, you got this money in, what is that? And then I have to tell them or provide them backup potentially. And this is really kind of a checks and balance just to make sure that our books are correct. And that we're submitting to the IRS, the best financials that we can.
Absolutely. So now that everything is over to our CPA Weaver, they review every single document. So those cost segregation studies that multifamily investors just love so much, they clarify some of the material changes. And I say changes, but those material items that will change year over year. And that's things like distributions, contributions won't change, but tell me more about how the kind of, what is the next step after that draft tax return is issued?
Oh, so after they've done their adjusting journal entries? Okay, so after they've done that, everything looks good. I send it to Rebecca. Okay, she goes into it. She says, hey, this matches our distribution spreadsheet. That's a big part of it. We keep track of all that, and Rebecca does a great job at that. And then I look at it and I say, okay, Are things making sense on my end? Did you try to do an adjusting journal entry behind the scenes and tell me about it? They wouldn't do it, but I had to make sure. And I basically just check with our books that everything makes sense. And also, I review the adjusting journal entries too. And sometimes they want to move things elsewhere, and I say, okay, let's chat about that, right? So yeah, and so once we all agree on it, then I think we just push it on to y'all. I think they put it on the share drive, and y'all just pop on in there.
You're exactly right, Matt. We give the green light to our CPA after we make sure if there's any address changes or if you transferred your investment from one investment vehicle to the next, then of course we're making sure that those changes are reflected. We try to catch them all. If not, we will have them all revised shortly thereafter. But once we have those final K1s for that particular entity, we're uploading that to your investor portal so that you can quickly get those get them in time for filing. And I forgot to mention earlier, Matt, this was actually the earliest we have ever issued K1. So our REEP investors, their 2023 K1s, we actually started issuing those, I want to say, around Valentine's Day, which isn't very romantic, but
it could be. Some people are into that.
Absolutely. But we know, of course, it is extremely vital to have those on-time filings for all of our investors. And we certainly don't want to slow down any process of that. And so we had I think the last K1s that we were issuing were March 13th, 14th, around that time frame of this year, which is standard. Far in advance of that April, this year it was April 15th, a personal filing deadline. At REEP, our investors have never had to file an extension because of our K1s. And that's something that we want to pride ourselves on, not only in 2023, but also we want to assure our investors of that in future years. Of course, if there ever is a slowdown or any type of delay, you will know long in advance. And now, Matt.
Yes.
This important document.
Let's go.
Yes. K1s. I know everyone has been waiting for this.
Yes.
But we want to just really be able to dive into this anatomy of the K1 in really today's topic. Again, want to remind everyone we are not CPAs or tax professionals, but we do want to educate our investors on the important information that's in your K1s. We know it's already past the filing deadline for 2023, of course, but this information I find to be vital to know on any investment, year. As year to year, not much changes on these tax reporting, on these documents. Of course, things will change, all the numbers year over year will change. But really the meat and potatoes of what to look out for, what to be able to say and reconcile either against the distributions you've received is really, really what we're going to cover in today's call. Now, Matt, you want to talk about part one?
Part one, simple, right? Take a look at it. It's going to give you your partnership's name, right? And all the information there. Also the EIN. And I'm looking at one right now in front of me here. It's also going to tell you, some silly things like where the IRS center it was filed and returned in. And so, and then also wants to know if it's publicly traded or not. That's basically part one.
Yeah. And this is important to know because we say, and this is an actual K1 from not 2023, but 2021, because we wanted to show you some depreciation losses and also what year over year K1s will look like, how they start to tie together. So this is an actual K1, hence why you'll see some blacked out information. But that box B sometimes investors will ask, I invested in Chartwell Court, or I invested in 4,000 Horizon Hill.
Right.
Why is that not reflected in Part B?
So one more time, the question. Make sure I'm answering that.
Of course, and it was a bit rhetorical there, but even though you're in our investors are invested in a particular property, of course, that property is held in an entity,
right?
Whether it be an LLC, LP, and of course, there as an investor, you are owning membership shares of that entity, and so you're going to see that same legal entity that was on the subscription documents, that is on your ACH distribution that comes through, or even your checks. If you're receiving paper checks for your distribution, that same entity will be the entity that issues K1s each year.
Right. Y'all own the entity that owns the property.
Exactly. And then part 2, this is information about the partner, about the investor. So this is your investment vehicle in box F. Whether it's your personal investment entity, you're investing through a single entity, trust, self-directed IRA, 401k, all types of things. Box E, of course, that's going to be your tax identification number, whether it be an EIN, your social, and you're investing personally. And then just going into further detail below box F, what type of partner this is. You'll see, of course, the limited partner or other LLC member. That box is going to be checked for our investors in these deals. As a reminder, you are a limited partner in either LLCs or LPs as a passive investor. And further down, you'll see ask questions, disregarded entities, everything that may not be applicable for all K1s, but if you have a disregarded entity, of course, then that information would go there. And then kind of section J, percentages of both profit, loss, and capital. You'll see that this is slightly different. And for our investors of REEP, you know that we do have different classes of investment that have different percentages of profits, cash flow, and capital. And so that is all there, and that will primarily remain unchanged year to year. Now, I say the important boxes, they're all important.
Well, J is important. Yeah, but yes.
But moving on to some of the more things that that investors want to really be able to see each year. I'm going to scroll down not that far down. Let's see. Did it again. So let's scroll down just to box L, and this will be on the left-hand side of of the first page of this K1. And that's another question I get asked a lot. Are all 20 pages of the K1 needed? Now, this is a question more for your CPA.
They'll say yes. Yeah.
But yes, there's a lot of information within the K1s. The majority of the information is going to be on this first page. And that is actually perfect. We'll cover that right there. Of course, this first page, a summary of the things to come. If you have a more a complex investment or investment through an IRA, then there's some subsequent pages regarding and relating to UBIT, unrelated business income tax, some footnotes information to file that Form 990T, all of the different things as it relates to your investment. It's all included, but I can personally say as a cash investor, I'm really just looking for this first page. And so let's start with box L, the capital account analysis. This was the first year of this investment. So you can see that beginning capital account, of course, was blank because on January 1st of that year, there wasn't an investment made just yet. But this particular investment, we chose a $100,000 limited partner because we thought it would be easy to kind of see not only the numbers, but also be able to see the percentages. This one had a particularly high amount or high percentage of that bonus depreciation.
Yes. And should we go into that? Do they want to know?
I'd love to.
Okay. Basically, it's a tax incentive to depreciate, right? You want to declare as much losses as you can. In the first year, when you purchase a property, we take what's called bonus depreciation, which is we take a big portion of that depreciation and we feel it all in that first year. And that way, you might get one of these and say, oh, wow, the company really took a big loss, but it's really there to serve you and to make sure that you declare as little as possible so you don't have to pay as many taxes.
We could talk for hours on the tax advantages of bonus depreciation and everything like this. But you're seeing kind of those losses, which is a result of that bonus depreciation from doing the cost segregation study and everything. That is in that line just below it, the current year net income or loss since it's a negative. So on this particular asset, we saw about an 85% year one bonus depreciation. Now, again, we say it with a large disclaimer, we're not CPAs or tax professionals, but I will say bonus depreciation is a game changer when it comes to your investments, but it's found specifically through multifamily. And that's what we love. Bonus depreciation, I don't know if you knew this, doesn't expire. You can carry it forward.
There it is.
And carry it forward indefinitely. Even beyond, if say this property sold in 2024 or 2025, if I didn't use that bonus depreciation, but then I wanted to use it, say in 2030, I could.
Wow. That's interesting.
It is very, very neat. And we really could talk for hours on that. But getting back to this K1, I want to keep going further down. Of course, this property, I mentioned the 85% bonus depreciation year one. And I want to remind everyone, this was back in 2021. We also acquired this property relatively late in the year. We only had about a month and a half of operations. And so we didn't have distributions for this current 2021 year. But I'm going to point out that ending capital account, that 15,022 at the bottom. And then if we can also pull up that second K1 from the picture or the screenshot, that is relevant because that ending capital account will actually be on the next year. So 2022, this particular K1.
As the beginning.
Yes. So let's see, still had some depreciation loss, that 7,000, right? Because depreciation.
It is mainly depreciation, but that's not your depreciation. It's just your ultimate net loss, which is heavily influenced by depreciation.
Absolutely. And then further down, you'll see the withdrawals and distributions, that line, $4,338. Of course, that 4.3% cash on cash return was sent to the investor in 2022. And then, of course, an even smaller ending capital account on here. Like I mentioned above, you'll see those beginning and ending profit loss and capital percentages. Those all remain the same. And if we can go actually back to the larger K1 because I want to talk about box 19,
Let's do it.
distributions.
It's huge.
It is. And we're happy to report here at REEP, we are still, our property is still distributing. Some of them are cash flowing very, very nicely.
Yes.
That, again, we talk about the tax advantages of investing in real estate, the appreciation, so many different diversification pieces to add to your investment portfolio, but the cash flow distributions.
Yeah, and that's something I'm happy to be a part of. And you have some businesses right now who are not able to do it, and some instances of cash calls. And I'm happy to say that, we have some properties where we are distributing.
And no risk of a cash call.
No.
In an industry that really has seen some bad press lately, some on cash calls or capital calls, as some people may refer to them. We're proud to report that REEP has never done a capital call. We don't intend to do capital calls. And each one of our assets is just very well capitalized, thanks to your help, Matt, and just being prudent and also making sure that these financials are squeaky, squeaky clean, as I like to say. But going back to that cash flow distributions.
Let's do it.
So I got distributions into our account.
Yeah.
And we do quarterly distributions here at REEP for the majority of our assets. Some of them are monthly, but on a quarterly basis. So say in about May, August, November, and then in February of the next year, we're receiving quarterly distributions as an investor. Quick little side note, the first couple times, and I don't think I told you this story, Matt. First couple times that we invested, and with every new investment that we invest in, the new distributions that we send out that first quarter, my husband will actually ask me, hey, I don't recognize this entity. Is this spam? Do I need to report it into our bank? To which I say, no, please don't call the banker. As a reminder, you sign the subscription documents. And that, of course, is the cash flow, the distributions that are coming from our investments held with REEP. But I mentioned that timeline because we do Q1, Q2, Q3, Q4 distributions. But even though I didn't receive the distribution that year, in 2023, it may not show up or describe that to me, how the box 19 may be different than what I actually received in that calendar year.
It's a good question. So we accrue for distribution. So what does that mean? So that means whatever y'all earned in distributions in Q4, we will put on the financials as if y'all had received them, but we will send them out, in Q1 of the next year. So you might look and say, hey, this doesn't match up. That's a big part of it. And of course, that works retroactively as well. So, you're saying, hey, I got this big distribution in January and I don't see it on here. Well, that's probably because it was recorded in 2022 in Q4. That's the big variance there.
There is. And even so, you mentioned Q4 and then having that discrepancy of what actually hit my bank account versus what is in box 19. And it just simply has to do with that recorded versus actually getting that distribution and the dates in between them.
Absolutely.
And let's see. Covered box 19. That's the one that I'm looking for. Box 19, box 2, that depreciation loss, just double checking as a passive investor before I send this off to my own CPA and get them filed for our taxes. And then the K1 that we used an example of, this was page 2, actually, right after the cover letter, of 19 different pages. But there's 18 other pages, I should say, really had to go into just more information, like I mentioned earlier, some investments may require information on UBIT or UBTI, all of those footnotes. So all of that information will be included in those footnotes. And then something in, I want to say probably, let's see, probably the past 4 or 5 years that started becoming more relevant was a Schedule K3 being included a part of your K1 package. Now, K3s have to do with foreign income, which we obviously do not have here at REEP. It is unnecessary because it relates to the foreign income. Then again, there is none, but it's a tax requirement that we have to include within these K1 packages. And you'll see a lot of zeros on that K3. Nothing required to report there. But that is, I'm going through my notes, Matt, and we kind of dug down into the anatomy of this K1, did it rather quickly.
Yeah, I think so. And, I'm sure you guys have questions, and, some might be a little specific to answer right now, but, I'm sure we can do our best if that's what we're on.
Absolutely.
Okay.
No, let's go ahead and answer all, let's see.
All right, here we go.
And as a reminder, we will be we did record this, and we'll be sending out the recording. If you'll just email invest@reepequity.com, we'll make sure that the recording is sent out.
All right, we got a question here. Which one are we doing? We're doing
let's do that one. If you'll repeat
okay.
the one that's
Curious.
right now.
And Part G will both be checked for a GP that also invests.
Good question.
All right.
So we have, of course, and all investors, limited partners in the deal, but Jacob and Arlene Garza for putting the deal together and signing on the note, doing everything. They're, of course, the general partners of every single one of these deals.
That's right.
And so as a member of an LLC, and I said member, so not manager, but every single member will get a K1, whether it be a limited partner or that general partner. And so that Part G of Part 2, or I should say Box G of Part 2, will be marked, but general partners within a deal, if they are both a general partner and coincidentally they're also limited partners in the deal as well, they will actually receive 2 K1s for every property that they are a general partner and limited partner in. It is separate. This particular K1 we showed today was solely a limited partner in the deal so that we could show you what it would look like as an investor.
I hope that helps. Can they see all the questions here? Okay.
And then the next one. Hi, Tom. How are you doing? It's a pleasure to see everyone again on today's call. But he says, we talk about depreciation and bonus depreciation quite often. And my understanding is that these will only benefit real estate professionals and not everyday passive investors. Is this true?
So depreciation helps all of our investors, right? It's the biggest loss that you're going to see on these forms. So, it's really one of the major incentives from getting into real estate is that you can make quite a bit of money and then, have a large depreciation loss. And so it does benefit everybody invested into multifamily real estate.
And we didn't mention one of the key terms that is used quite frequently here in multifamily real estate, and that's that real estate professional status or that tax designation to really be able to kind of, I want to say, amplify the power of that bonus depreciation. Bonus depreciation is, of course, given to all investors that are in the particular asset or entity, whether or not they can use it. So Tom brought up a couple of great things. The first one, real estate professional status. I can't remember, goodness, it's over 500 hours on a particular asset. It has to, I believe, has to be outside of a W-2. Each CPA I've met with has a little different explanation of what this real estate professional status and what qualifies to be that real estate professional or reps qualification. Personally, I can say I don't qualify for one because I have a W-2 that is in real estate. However, I've heard from other investors that their CPA does allow them to still be able to take that, that designation while also having a W-2 job, whether it be in real estate or not. And so I would check with your CPA on that. I'm still using the bonus depreciation. And again, I'm speaking just personally on my tax situation. So the bonus depreciation that's on our K1s from 2021, 2022, even this last year, 23, we are actually carrying those losses forward until we sell those assets. So to date, I can say that I have not used any of this bonus depreciation, still waiting for those properties to come full cycle. But when we do, we'll have, of course, those capital gains and be able to offset any of those capital gains with the bonus depreciation of these assets.
Yeah, yeah, and that was really well said. And Tom, I'd just say, yeah, if you know, the more specific we get on this call, I think, you know, reaching out to a CPA would be best. But
Absolutely. And then the last part of that question, self-directed IRA. This is another one that kind of is a bit wonky. I don't have much personal experience in this just yet, but after a lot of research, I have heard from other investors that the bonus depreciation from an IRA investment can help offset the unrelated business income tax. Of course, hasn't been proven or been tested personally, so certainly recommend consulting your CPA or tax professional, but I can say it's powerful.
yeah, definitely. It's your friend.
Yes, it is certainly your friend and has many uses and many applications. Let's see some other questions.
All right, how many do we have? Is this all of them? Oh.
Let's go back up. Let's see. Strictly passive investors, do they have any material participation?
See, where is that on the K1?
It actually is not. I believe
Okay.
this has to relate more to the real estate professional status.
Ah,
But I would be curious to learn more of what material participation means. To some, that just means watching the webinar, spending some time, some due diligence before you make that investment, reading the reports. If you come to one of our bus tours, one of our events where we showcase the property, that of course can be, I believe, can be considered that material participation of the deal. But as limited partners, they're not making the, you know, any decisions on the operations, the day-to-day, asset management, none of that. And that's true for any limited partner. And same thing on special handling. I would want, Vo will certainly, I'd love to continue this conversation further just to get further clarification on that. But Vo, your next question, box 16.
yeah,
and
that's the K3.
Yes, it's checked on every K1. No, and you're exactly right. No foreign income, no activity. But it was a requirement goodness, I want to say 2020 or 2021 started to become a requirement, a part of all K1s. You won't see anything within that K3 that is foreign. It'll all be either blanks or zero, as it's not applicable for these investments. And then the last question I saw was, are all of my investment at risk? So as a limited partner, I also kind of forgot to go into the recourse, non-recourse.
Oh, yeah,
Yeah, section K,
Yeah.
but the partner's share of liabilities. So of course, as a limited partner, you are only at risk for your investment. Even the type of debt on these properties is non-recourse instead of recourse, but even those kind of guarantees or carve-outs, Jacob and Arlene sign, or the general partner on your multifamily deal, they will sign on those guarantees,
Right.
not any of the investors.
Exactly.
But Bo, I can say all of your investments here at REEP, none are at risk.
None.
We are, all of our performance of the properties are doing well. A little birdie told me our occupancy is the highest it has ever been, portfolio, and this is portfolio wide, which is quite a lot to say, because we have some properties that are going, into their business plans, kind of seeing those units turn over. And so we're not at that, nice high 95% stabilized occupancy for those particular assets just yet. But overall,
yeah, we average in the 90s for sure. And our portfolio is doing great. And from a cash perspective, I couldn't be happier.
I love it. All right, let's get to some more of these questions, Matt. So this one says, when the property gets sold and there is a large final distribution. So I'm going to assume, yes, investment amount of $100,000 initial investment, plus an additional distribution of $50,000, so total $150,000 final. Can you clarify if this full amount, $150,000, is subject to income tax?
Okay.
Absolutely.
Yeah, no, I'm reading it. Hold on.
And while you read it, Matt, I'm going to clarify. So this is a really, really great question. And I love the $100,000 example just for rounding simplicity. But let's go ahead and also assume $50,000 was paid prior to the sale. So $50,000, of course, was returned through those quarterly distributions along the way. Gosh, and on a 5-year hold, that's a 10% cash on cash return. Not bad. You cannot complain about that 1 minute. So when we went to sell the property, your basis in the property was $50,000. Of course, all investors or limited partners are made whole. So after we receive kind of that wire from title and the sale of that asset is cleared and done, we return all investor capital first before anything is split based on the type of an investment class that you invested in. So typically that's an 80-20 split. We have some properties that have different classes, 85-15, 90-10, 70-30, just depending on that particular investment. So investors are made whole, right? First. So the full 100,000, you are given back 50,000 first, even though, and Matt, I'm gonna say a couple things, but I know Matt and his team only issues one check. And as an investor, you only receive one check, but it's important to understand the different components of that distribution check.
Yeah, and I think if the question is, look, I got 150, is the whole thing tax? It's only your gain, what's been qualified as your gain on the sale of the asset. So not necessarily the whole full 150,000.
Absolutely. And even though receiving that check of, in this particular example, of 150,000, so 150,000 on this sale, already receiving 50,000 from prior distributions.
Right.
So in total, an investor would have received $200,000 on a $100,000 investment. And again, only that gain is what is taxable, right?
That's right. You get taxed on your gain, essentially, and that's, you know, with all your losses included. You know, it can get messy if there's a ton of distributions and stuff, and that's part of what the K1 is for. But you know, and obviously, you know, some people have different income brackets, and there's a million different things. So the more specific we get into this one, I talk to a CPA. But the short answer is, you don't get taxed on all of it, just your gain.
I've learned that tax situations are as unique as thumbprints.
Yeah.
Every single one is different. I honestly haven't ever seen two that are the same. But one of our long time and repeat investors mentioned that one thing all passive investors want to understand, that the loss from bonus depreciation, when you sell, that depreciation recapture, which does happen with any asset that has depreciation. There is that bonus, or not bonus depreciation, but depreciation recapture at the end. You make a great point. Invest in the deal for the return, not for the depreciation. And that's something that I think is a really good general rule of investing. Making sure that not only you're investing for the overall return, but you're investing with someone you trust, someone that has a nice track record. And the depreciation, really, I like to say it's kind of the sprinkles or the cherry on top.
I like that.
Not quite the ice cream, but
yeah. Yeah, that's good.
750 hours. Okay, I think that had to do with the real estate professional status.
Right.
Of real estate activities, and this is annually. That's another thing I have learned. Sometimes investors will say, "Hey, Rebecca, I think we talked on the phone for an hour last week." And I say, "Yes, we did. And yes, I realize that is for your logging of the real estate professional status." And every email is probably, I want to say probably 30, 45 minutes to draft up, write, and send.
Yeah,
well.
yeah.
So of course, for those investors that are logging their hours for the rep status, by all means, those conversations, those emails, those webinars, and just like today, the due diligence and education of these assets and of these investments.
Some of these comments, you guys know your stuff, and I'm very impressed. And I don't know if we should read some of them. We'll let Rebecca decide.
No, I completely agree. Multifamily investment from an IRA incurs unrelated or UDFI tax. This is also referred to as the unrelated business income tax, or UBIT, which I would have thought of a much more clear term than UBIT, because it is related to the business, it is related to the property, but based on the leverage portion. So that is correct. The higher the leverage, higher the percentage of UDFI tax or UBIT tax on that particular investment.
Someone has a question about rolling your gain. Is that something that we allow them? Is that something that they can do? I'm not sure.
Good question. So there's I want to say two topics that this brings up. 1031s, which as investments from 1031s, those have to be into direct or ownership of direct property. So that's really pretty easy to do on like single family assets, or even commercial buildings, going from property to property. But remember, as an investor in these assets, you don't have direct ownership of the property, but rather ownership and interest in the entity that owns the property. So it's a little extra added step that doesn't quite allow for that simple and nice, easy 1031 from one asset into another, one investment, rolling that into another. But we were talking about bonus depreciation a lot earlier. And one of our key, the thing I love about bonus depreciation is that as you have an investment go full cycle and have those nice gains, being able to reinvest those funds and get more bonus depreciation from a separate investment. If you already used the bonus depreciation from your first investment or that particular asset, and that I heard the term many years ago, and I hate to claim it. I wish I would have thought of it myself, but calling that the lazy 1031. So using the gains of one investment or using the bonus depreciation of one investment to offset the gains of another investment, and really just recycling and repeating the cycle. One thing I think I may have seen a further question down, bonus depreciation. And right now, I believe it's at 60% in 2024. Fortunate for real estate investors, it did pass the Senate, and I believe it's on the floor of the House to go back to that 100% bonus or 100% realization of bonus depreciation. The last time we saw 100%, I believe, was 2022. 2023 was only 80%. So even today in 2024, even though we're at 60% bonus depreciation, that members or investors of an LLC, an LP, or an entity can take, it's still a lot of depreciation.
Oh, yeah.
And we're fortunate it's better than nothing. Because if you haven't been able to use bonus depreciation or just really be able to see the power of it before, it is very, very impressive, and something really unique to multifamily real estate investors. I know we are coming up on the top of the hour, so I want to make sure if any other questions that we can cover on today's call. Of course, if you have any questions, you can always reach out to us at invest@reepequity.com. But if you're not a member of our investor network already, please feel free to also email us, but also visit some of our resources on the REEP Equity website. We have a brand new knowledge center outlaying all of the blogs, previous webinars, our REEP huddles, just like what we had today, as well as any podcast, speaking engagements, and upcoming events. We are just really, really excited to share that information with our investors. And as Matt mentioned, we have a lot of very, very knowledgeable investors. And we strongly believe that a more knowledgeable investor is actually a more powerful, smarter investor.
Of course.
As they have those tools within their toolkit to continue a very successful investment journey.
Yeah, Nand really knows his stuff. All right. Well, and if you guys have any questions about financials in general, I don't know how much time we have left, but again, I'm not a tax guy, but I do prepare all of REIT's financials, and I'm happy to answer that, unless we're running out of time.
No, do you know, Matt?
Yeah.
Actually, so as with all of our investors, we send out monthly reporting.
Yeah.
And so when I get my reports, not only because my team here at REEP also sends them out, but also as an investor reading those, I'll normally read the summary, just review, of course, the balance sheets, T12, everything that we send out. My husband,
Mm.
I'll be lucky if he opens the email. And I'm not sure if he's on today's call, but he will he will admit he's a very, very passive investor. And want to remind everyone, all of our investors, and as an investor in REEP, every month you are receiving the property's T12, so that trailing 12-month cash flow statement.
It's an income statement.
Income statement. We call it a profit and loss statement as well. But just showing, of course, all the income, expenses to the property. We also send out a market survey of the asset and the nearby comparable properties in that submarket, also a rent roll, and that balance sheet. So you can really be able to see how everything ties out. And I would certainly recommend, I know our REEP investors, look at those financials, but for your other investments, even if you're not receiving those monthly financials, ask your investment partner, are they providing those? Can you get a copy of them? As an LP, if I invested in properties that didn't provide those financials, you can bet I would have a lot of questions as to what was the income, what is the expenses, and ultimately where's that reflected, so that when it comes time for these K1s, it's done very timely, and it's a very smooth, fine-tooth comb, very easy to wrap up the year and wrap up tax season.
And I was happy to get everything on time, and maybe next year will even be quicker. So I'm gonna knock on wood there, and all indicators say yes, it will.
Oh, yes. Well, Matt, very much appreciate your time joining your first REEP Huddle. We also want to extend our gratitude to everyone who joined us today. Of course, the recording will be available of this REEP Huddle. And as always, thank you so much for joining us. We hope you have a great rest of your day. And as always, thank you for joining us.
Thanks, guys.